Simple interest. Imagine you lend a friend £100, and as a thank you, they promise to pay you £5 every year. After year 1, you get £5. Year 2, another £5. Year 3, another £5. You get the exact same amount every single year, no matter how much time passes. This chart shows how your money grows using the simple interest formula. We take your starting amount, which banks call the principal, and multiply it by the interest rate and the amount of time. Because you only ever earn interest on that original starting amount, the growth forms a straight upward line. It never speeds up and it never slows down. If you put £1,000 into a savings account earning 5% simple interest for 3 years, you earn exactly £50 in year 1, £50 in year 2, and £50 in year 3, leaving you with £1,150. The same exact math applies to debt. If you borrow £2,000 at 8% simple interest for 2 years, the interest is a flat £160 per year. You will owe £2,320 in total. While simple interest is a helpful way to learn the basics, you will almost never see it in a modern savings account or credit card. To see what banks actually use today, we have to look at a much more powerful force. Imagine packing a snowball and rolling it down a hill. At first, it only picks up a little snow. But as it gets bigger, its larger surface area grabs more and more snow with every single rotation. It grows faster and faster entirely on its own. That is how compound interest works. Instead of earning money strictly on your original deposit, you earn interest on your interest. This chart shows what happens when we apply a 5% compound interest rate to a £1,000 deposit. In year 1, you earn the standard £50, but in year 2, you earn 5% on £1,050. Which gives you £52.50. By year 3, you are earning interest on £1,102.50, pushing your payout to £55.13. The real impact of compounding requires time. If we owe the £1,000 alone at a 7% interest rate for 40 years, simple interest will eventually bring the total to £3,800. But with compound interest, that same £1,000 grows to £14,974. You end up with nearly 4 times as much money, simply because your interest was earning its own interest over those decades. How often that math is calculated also matters. A bank might calculate your interest annually, monthly, or even daily. The more frequently the bank calculates and adds the interest to your pile, the faster the snowball grows, adding a few extra pounds to your total each year. If you want a quick way to estimate this growth in your head, you can use the rule of 72. Just divide the number 72 by your interest rate. If you have a 4% interest rate, 72 divided by 4 is 18. That means it will take roughly 18 years for your money to double. But there is a catch. The exact same mathematical force that aggressively grows your savings will also grow your debt. If you carry a balance on a credit card, the bank uses compound interest against you, meaning you are paying interest on your interest. When you borrow money or open a savings account, you have to decide how you want to interact with the broader economy. One option is a fixed interest rate. This acts like a shield. You agree to a specific percentage, and the bank locks it in for a set number of years. You know exactly what you will pay or earn every single month, regardless of what is happening in the news. For example, in 2021, many homeowners signed mortgage agreements locking in fixed rates around 2%. Over the next 2 years, borrowing costs across the country shot up. People without fixed agreements saw their monthly payments jump by hundreds of pounds. But the people with fixed rates, their monthly bills didn't go up a single penny. The alternative to a fixed rate is variable interest. Just as the name suggests, this rate can float up or down at almost any time based on the health of the economy. Your rate today might not be your rate tomorrow. The main engine driving those variable rates up or down is the Bank of England. They set what is known as the base rate. When the central bank raises the base rate, it becomes more expensive for regular banks to borrow money, and they pass those costs directly onto you in the form of higher variable interest rates. Each path has a clear trade-off. Fixed rates give you perfect peace of mind for budgeting, but if you want to break the agreement early, banks usually charge hefty penalty fees. Plus, if interest rates drop across the country, you are stuck paying your higher locked-in rate. Variable rates give you the freedom to leave at any time, but you carry the risk of your monthly costs suddenly spiking. Ultimately, choosing between a fixed or variable rate is a calculated bet on where you think the economy is heading over the next few years. When you start shopping around for these rates, things get confusing quickly. One bank might offer you a savings account at 4% calculated annually, while another offers 3.9% calculated monthly. Because the compounding frequency is different, it is mathematically impossible to know which deal actually pays you more just by looking at those numbers. To stop banks from hiding behind confusing math, regulators stepped in to create a standard measure called the annual equivalent rate, or AER. The AER takes all those different compounding frequencies and converts them into one single comparable annual figure for savers. On the borrowing side, we have a similar tool called the annual percentage rate, or APR. Lenders often try to attract you with a low interest rate, but then bury mandatory fees in the fine print. The APR forces them to combine the interest rate and those extra fees into one single true cost percentage. However, you have to watch out for the phrase representative APR on loan advertisements. By law, banks only have to give that advertised rate to 51% of the people they approve. The other 49% could be assigned a much higher, more expensive rate. This chart shows the golden rule for navigating financial products. Whenever you are comparing savings accounts, ignore the promotional text and look strictly for the highest AER. When you are looking to borrow money, look strictly for the lowest APR. Even after you find a great rate and let your money compound, there is one final hurdle. When a bank advertises a return, they are showing you the gross interest. This is the amount your money earns on paper before the government evaluates it for taxes. In the UK, the government allows you to earn a certain amount of interest completely tax-free every year through something called the Personal Savings Allowance. For basic rate taxpayers, your first £1,000 of interest is yours to keep. If you're in a higher tax bracket, that allowance drops to £500. If your earnings cross that threshold, you have to pay tax on the extra amount. What is left over is your net interest. This is the actual cash that lands in your pocket after the tax authority takes its share. You can protect your money from this tax completely by using specific accounts, like a cash ISA. Think of an ISA as a protective bubble for your savings. Any interest you earn inside that bubble stays permanently hidden from the tax office, meaning you get to keep every penny of your earnings. Interest is the invisible engine that drives the entire financial world. Whether it is growing steadily in a straight line or compounding like a snowball over decades, it is always running in the background. By understanding exactly how these rules work, you stop being pulled along by the math, and you can finally start using it to drive your own wealth forward.